This is MaiCoin with MaiView. This is not investment advice. How to avoid Bitcoin riches to rags. During the last 4 years, there is no shortage of stories from people who have made life-changing wealth in Bitcoin on the way up in 2015 to 2017. More than 100 times from peak to trough in some cases, only to lose much of it in 2018 during the bear market. In the following few minutes, we will explain why an investment into Bitcoin requires a different type of mindset, why so many people lost money in the last cycle, and present a basic plan of how to potentially avoid this in the next few cycles of Bitcoin. An investment in Bitcoin is like an investment in the internet in the 1990s. So firstly, let's discuss why an investment in Bitcoin requires a different mindset. As they say, an investment in Bitcoin is like an investment in the internet in the 1990s. So what does this mean? It plays on the idea that many, if not most people in the 1990s, including myself, had any idea at the time of the potential of the internet from both an investment standpoint, but also the broader implications for society. Focusing on the investment standpoint, let's use Amazon as a benchmark of buying the internet trade in the 1990s. Amazon traded higher by more than 8,000% from 1997 to 1999. It didn't surpass that peak of the 1999 bull market again until 2009, some almost 10 years later. However, even if you had bought the 1999 peak, 19 years later, you would still have made 1,652%. Not bad. Had you bought the bottom of the Amazon 95% collapse in 2000 and running into 2001, you would have made more than 36,000% until today. So the takeaways here are, number one, buying into internet proxies at any time during the 10 years from the late 1990s produced some insane returns on longer time horizons. And two, even Amazon saw some insane volatility in its first 10 years, but investors were compensated by outsized returns over longer time frames. This is what a comparison of Bitcoin to the early internet is about. Just as buying Amazon was seen as very risky in the early 1990s, over the longer term, it was one of the best investments you could have made. Bitcoin is deemed just as risky as Amazon was back then. Most people see it going to near zero or going up 10 times, maybe 30 times, or maybe even 100 times over the longer term. It's not an asset you should buy for a 10% return. There are lots of assets with much lower risk and volatility profiles that you could buy to do that. This idea of an asset that could trade to near zero or go up multiple times is described as having an asymmetric return profile. They allow you to make a smaller sized investment, but that can make a material difference to your net worth on the upside if you are right, and make only a small dent in your net worth if you are wrong. One last point on this topic before we move on. A colleague said to me the other day that he bought Google in 2006 and sold it in 2008. He thought he was a rock star. He made more than 100% return. He never bought it back. Had he held it until today, he would have made 600%. Had he bought the 2008 and into 2009 dip, he could have made 800% until today, which is almost 2.5 times the return he would have made had he bought the S&P 500 at the same time. This highlights one of the biggest mistakes most investors, including myself, make. We are conditioned to sell something that goes up 50%, 100%, and definitely 200%. And find it very difficult to look beyond timeframes of more than a few years. After we sell, we also find it very hard to buy it back. True wealth is created by trying to condition yourself to think in longer timescales and as much as possible ignore short-term volatility. What is an appropriate investment in Bitcoin is the next question. Any investment in Bitcoin should be appropriately sized, which is often described as no more than 1 to 2% of your total assets. In that way, if Bitcoin traded significantly lower, it wouldn't materially affect your life. Other reasons for starting with a very small allocation to Bitcoin would be initial lack of sufficient knowledge on Bitcoin, a subject matter that is continually evolving and sometimes very complex. As a frontier asset class, the risk could be much higher than with other mainstream investments. An expected asymmetric return profile as described earlier. So Bitcoin's return in the bull cycle, which ended in 2011, was more than 3,000 times. If you look at the bull market that ended in 2014, had you bought the trough and sold at the peak, you could have made more than 500 times. And in 2017 cycle, which had you bought in 2015 and sold at the peak in Q4 of that year, you would have made more than 100 times. Thus, with a very small outlay, it may be possible to make a very meaningful difference to your financial well-being should the cycles continue to exhibit similarly outsized returns as they have in the past. In this second section, which we like to call I want the car, the apartment, and the private school, we will move on to address why so many people lost money in 2015 to 2018 Bitcoin cycle. To do this, we're going to use an example, using real price data from that time period. To start off, let's say you invested $1,000 in Bitcoin in the lows of 2015 at approximately $200. 2 years later, you've already got a 10 times return on your money, and you can now buy that car you've been wanting and dreaming of for months and years, but you still have some niggling fears that Bitcoin could go to zero. Despite this fear, with 2 years of knowledge now under your belt, your conviction to be involved is creeping higher, and you manage to hang on in there. 4 months later, you're now at 30 times return. You now have value in Bitcoin, equivalent to a deposit for an apartment, and whilst you may not believe zero is now a likely option, it's still in the back of your mind. You once again overcome this niggle and stay invested, helped by your ever-increasing knowledge. 2 months later, and you're now at 60 times return. Now you could put your child through that private high school you had always dreamed of, and by this point, you're convinced in Bitcoin's value, and start to think that the boom-bust cycles of previous years may be a thing of the past, as the asset class seems to be getting some serious mainstream adoption. Just 1 month later, you're at 100 times return. There is no question in your mind of Bitcoin's survival now. You envisage a time not too far away where you no longer use any fiat paper money, and may even see yourself as a guru investor, come Bitcoin evangelist. Why choose between the car, the flat, the school? You can have them all. The following year, Bitcoin drops more than 80%. You capitulate and sell everything at the lows. Your wife leaves you, and after paying some tax, you have little to nothing left. This emotional roller coaster we have described is a journey many Bitcoin investors found themselves on, and explains why so many fail to benefit from such massive gains during the bull market. Now we're going to move on to the final part of this video. Now we move on to the final part, which we call Know Yourself and Set Investment Objectives. Here we're going to look at an investor who managed to avoid the pitfalls that we just explained. This investor, a real friend of mine, was somewhat lucky to have worked in finance for over 15 years and knew very well the pitfalls of becoming emotionally attached to investment. At the outset, he asked himself some very simple questions. What return in an ideal world would he like on the original Bitcoin investment? And secondly, how much of the original or initial investment would be medium term, let's say 2 to 3 years, or longer term, let's say 5, 10, 15 years? With these questions answered, he created a simple table. So as an example, using price data from earlier this year, we have the price at which you bought your first Bitcoins, which was $4,000. This is then followed by the number of coins, in this example 10, and the total dollar cost of those 10 coins. In this example is now $40,000. Then you have to decide what percentage of the holding is for the longer term. In this example, 50%, so 5 coins. This will leave 5 coins for sale in the medium term should the price move materially higher. After that, you have to decide what return or what dollar value you would be willing to sell these 5 coins at. In this example, we use $200,000, which you assume is the amount deemed as life-changing for this person, which of course means different things to different people. Finally, you take that $200,000 target, you divide it by the number of coins you're willing to sell in the medium term, the 5 coins, and you get a $40,000 target price, the price at which you would be willing to sell. Whilst you want 40,000 as the price to sell, the reality is likely to be very different. A couple of things could happen. Firstly, Bitcoin as an investment could do very well, but may never get anywhere near your target price. Secondly, it could hit a level slightly below your target and trade sideways for a number of years in a range, or it may actually significantly overshoot your target. To manage these two risks, this investor came up with a second and final spreadsheet. So in this spreadsheet, it shows the target sales over a 20-year period. The part highlighted in orange, sales over 20 years, seeks to hedge against 0.1 above, which is where price never gets anywhere near your target level. In this example, he planned to start sales in year 3, so he assumed no sales in years 1 and 2, although that may depend on both your entry price and your investment horizon. Then, after these 2 years of selling nothing, he assumed selling 5% of the original 10 Bitcoins every year for 20 years. The second part of this table is the part highlighted in red. This part seeks to partially avoid the risk associated with the second point we highlighted, which is if the price of Bitcoin hits a level slightly below your target price and then never recovers above it, or it hits a level that significantly overshoots your target. So when we started the investment, we agreed we would be willing to sell half the investment, or 5 coins, at an average price per coin of $40,000. To avoid the risk we described, we picked 2 price levels, both below and above our target. If we manage to sell 1 coin at each of these 5 stated price levels, our average will still be $40,000. The reality, of course, will unlikely to be this clear-cut. Whilst on the table it shows these potential sell targets happening in the first 10 years, this of course could happen at any time, or not at all. So the key here is that whatever year these target prices hit, be it in the first 3 months, or 6 months, or 1 year, or 3 years, you stick to the schedule as close as possible. Hopefully, the basic ideas represented in this post and how to remove emotion from investment have sparked some ideas around how you could manage some of the psychological risks associated with an investment in Bitcoin. It should be noted that past performance of Bitcoin and other crypto assets may not be indicative of future results. There is definitely no assurance that the future performance of any specific investment strategy, or product related to Bitcoin and cryptocurrencies more broadly will be profitable, or equal any corresponding indicated historical levels, or be suitable for your portfolio. This was MaiCoin with MaiView. Thank you.